I closed out a portion of my QQQ short position this past week and hedged the rest using a long position in the QQQ, which is a leveraged product putting you long of the Qs. Not because I was wrong on the market, but because the market stopped rewarding pressure. And we began our bear operation on the Qs back in October, so it's been a while. And if you're trading like it was last month, this is the exact moment you start giving back any profits that you may have made, or if you're sitting with a loss in a short position, you're probably going to begin to bleed out a bit. So what I want to do here today is walk you through where I believe the Qs are going and why I closed out a portion of that trade, the short trade, and then talk to you about a couple other stocks that we like on our watch list. Let's get to it. So this chart here is a weekly chart of the triple Qs. And you'll note that back in October, the week of October the 27th, we put in all-time record highs. Since that time, the Dow Jones, the Dow Transports, and the S&P 500 have all hit, I forgot about the Russell Small Caps, have all hit all-time record highs. The triple Qs have been, believe it or not, laggards. So as we proceed into what I like to call silly season, also known as earnings season, I believe that what they're going to do is they are going to rally the Qs. Remember that sector rotation is the mother's milk of any bull market. So while we could argue that the S&P 500 is very overvalued, the triple Q names are very overvalued, yeah, you're right. But what matters is what the market is telling us, and the market is telling us that the triple Qs want to break out. How do we know? Simple. Let's take a look at this chart here. Take note of this weekly chart. We broke out above this resistance level last week. Now, what does that tell me? Well, it tells me that this prior lower band of support could quite very well be the new upper band of resistance. So when I say I took a portion of my short off and I hedged another portion of my short, the reason is that we need to trade with a plan. And if we're not going to trade with a plan, we are going to begin to hemorrhage capital. And we can't do that. We can never do that. So what I expect here to happen this coming week is that in all probability, we are going to get a retest of this breakout point. At that point in time, I may lighten up more on that short. And by the end of the week, I may be neutral with a bias to the long side on the triple Qs if they break out to new weekly higher highs. Remember that this time of year, in addition to the technicals, in addition to the price action, and as well as the volume action, volume was very good last week. In addition to that, you have seasonality. Seasonality this time of year, January for the triple Qs, is pretty good, 63% up. Now, February, that changes a bit. I don't believe that we're going to be going into a healthy next leg of a bull market. I think that we're going to be going into potentially the capitulation phase of a bull market. Current, you have the Shiller-PE ratio sitting at nearly 41. The high was back 44 back in 2000. So we're not talking about a cheap market here. We're talking about a market that is very frothy. The however is that we continue to get news that comes out. Weak economic data sending yields down and setting the stage for a stock market that could expand out to the upside. Now, our longs did very well last week. We're long of UPS, Boeing. The transports did very, very well. Our energy plays did very well. So net, it was a good week, but now it's time to take that macro play, meaning our big short of the Qs. Let's take that macro bet that we put on the Qs to the short side. Let's reduce that size. Let's reduce it to the level where we could sleep at night and then extrapolate out, going back to that weekly chart and say, okay, at some point in time, if I'm accurate and the shares of the triple Qs do in fact rally, which I hope that they do, then we could reshort the very same shares yet again using SQQQ. That's a short vehicle for the triple Qs at lower prices. Now, in sticking with this chart here, I want to point out other bullish factors. And there are reasons as to why we closed out a portion of that bet and put on hedges. We're putting in higher lows. So for a while there, while our short was working back here, it looked as though, okay, we had the path of least resistance right, and it was moving to the downside because we had broken this uptrend channel. Now we've begun to put in higher lows and we've broken out. And once we begin to break out and above 631, and God forbid, if you're short and you're holding on still above 637, I'll tell you right now, there's a bunch of stop loss orders up there, and meaning by shorts, and you're going to get your face ripped off if you don't understand the dynamic of the market and what could soon be happening if you are still short of the triple Qs in any size per se. So that's one of the reasons why we covered a portion of the Q trade. Now, when you take a look at the daily chart, you can see here clearly, and this is what sold me, was that we had the breakout here. I put my hedge on here because I was worried that we would just rip through and move up higher, but we didn't. We pulled back here, and then on Friday, we got follow through. That told me that the bulls were in charge. It doesn't matter how expensive the market is. The bulls are in charge, and you could tell that by the volume. You could tell that by virtue of the fact that we're putting in higher lows, and we closed just off the highs of the day. You have a Bollinger Band squeeze setting up here. Bollinger Bands in red, trading inside the Keltner channels. If we break out to new weekly higher highs, this is probably going to be a rip-your-face-off rally on the triple Q. Do I think it lasts? Absolutely not. Do I think that we will be heavily short yet again and probably bigger on the SQQQ, the short vehicle, than we are right now? Yeah, probably. But the key is maintain your liquidity. If you're not treating trading as a business and you're not focused on your liquidity, you got a lot of problems. So this is not the business for you. So moving on to a couple of stocks that I like here. And one, we actually booked profits on last week. DRV, this is a real estate short vehicle. Now, we booked profits here. We bought it about, 8 weeks ago. We booked about 6.5% profits. It's a tight Bollinger Band squeeze here, much tighter than what you saw on the triple Qs. I worry that the rhetoric coming out of Washington is going to serve to drive yields down. That is bullish for real estate. So what did I do? I didn't let our profits slip away. We were up higher, but we gave back some, but I didn't want to give it all back. I just said, you know what? Let's book profits, 6.33% profits. We're good here. Let's wait and see. Because when you take a look at a weekly chart, you can see that the Bollinger Bands here are widening out. It implies that in all probability, we're going to break out to the upside. The key is that you need to have longer term yields, 10-year, 20-year, 30-year yields moving up higher. That puts pressure on real estate. We're not seeing that right now. We're seeing really a tug of war between bulls and bears and which direction the yields are going to go. So right now, we like DRV. We will probably be back in DRV, but only when it either A, pulls back to a support level, or B, once it finally breaks out with the condition that the 10-year yield is also moving up higher, right? Those are the correlations that make this trade work. Now, before we go on to the other stocks that I like for this coming week, I want to talk about Taiwan Semiconductor. I went over this last weekend on Best Stock Charts. It's on YouTube. I'll link to the video at the end of this one. And you can see here on a weekly time frame that we had a nice rally on the week. So we were accurate with our prediction it was going to move up higher. Fine. We didn't chase it though. Daily chart. So they moved it up higher last week. They faded it. And what did they do on Friday? They broke it out. This is why Taiwan Semi remains on our watch list for the new trading week. Members, I will be sending out a trade alert if and when we do get long of TSM. Another one that I like from last week, WES, that also moved up higher last week. We're not going to chase these. They need to come to us. So right now, this is not in play for us. If it pulls back to an orderly support level, we'll look to step in. So WES right now, it's still on our watch list, but it's not in play right now. It's a little bit extended as reflected here. Now, a couple of new ones. VRSK, the industrials are doing very, very well. Now, VRSK, let's take a look at a monthly chart to give you context. Now, to me, this is clearly in a bear market. The thing to remember here is that from a risk-reward perspective, it looks as though we may have stopped going down. There's your support level at around 216 per share. Now, let's go to the weekly chart. You could see that last week, we showed a sign of potentially getting a follow-through week because we broke out the week of December the 29th. And last week, we did a retest of prior support, which is always like a great OCD type of retest that technicians like me like to see before we get long of a trade. And we had somewhat of a follow-through, RSI, pushing up higher here. So very interesting chart to the long side. It has not participated in the industrial rally. But I think, though, that this is probably going to be one of the ones that begins to get accumulated. So again, members, I'll be sending out alerts when we do begin bull operations on VR. The last one up is going to be Trinity, TRIN. And I had been talking about this one for a while. A high yielder. At current, it's yielding 12.9%. Now, what I would like to see here is a retracement after last week's behemoth move up higher. I mean, this is a big move for this stock, over 5% in a single week. We need to see a retest of one or two support levels, and then we could begin bull operations on Trinity Capital. So in closing, if what I just spoke about with the triple Qs felt a little bit uncomfortable and a little bit familiar to a situation that you may have been in before where you could argue that you fought the market, take a lesson from my playbook. I've been doing this for a long, long time. It never feels good to take a loss, never does. But when the next trading day opens up and you see that you are accurate in reducing size, and size is the number one killer of all traders, that loss seems like nothing. Your confidence emerges back again because you know now that you have the capital on the sidelines. You didn't fight the tape. And now what you're looking for is a better risk to reward re-entry point at which to reestablish, in this case, a short position on the triple Qs. Right now, I would be a net buyer of the Qs on a continuation breakout week over week. So we have zero intention of fighting any breakout on the triple Qs. Now, is it overvalued? Yes, no doubt about it. Is the Federal Reserve going to cut rates? No, they're not. That should be bearish for stocks. Is the yield curve moving up higher? That should be bearish for stocks. All those bearish things matter, but only when the market says, now we're going to pay attention to them. Right now, the market doesn't care about valuations. It doesn't care about the yield curve this and the 10-year yield that. It doesn't matter. What matters is that the bulls are in control. They broke the Qs out last week. They're going to take it up higher in all probability. So do you want to fight the tape, or do you want to preserve capital, and do you want to live to play another day? That's it, folks. Talk to you on Sunday Night Futures Live. Be well.